We are very focused on, more pure play future winners. I'm not saying the Mag 6 won't win. In many ways, they will. But they certainly, any company that is in the broad-based benchmarks and has risen to the top has gotten there because of past performance and a certain DNA that worked during the last 20 years or so. We think there's so much disruption happening now, technologically enabled disruption, some that will benefit, some that will not benefit.
Cathie Wood begins with a critical reframing of the recent economic slowdown. Rather than a single headline-grabbing recession, she argues that the U.S. economy has experienced a rolling recession, one that moved sequentially through different sectors. Housing was hit first, as higher interest rates crushed affordability. Manufacturing followed, pressured by tighter financial conditions and declining demand. Small businesses felt the squeeze next, as access to capital tightened. Consumer sentiment weakened, reflecting cumulative stress across the system. But here's the key point. Because the recession rolled through the economy rather than hitting all sectors at once, the overall system absorbed the shock without collapsing. As a result, much of the economic pain may already be behind us. Before we go on, just a quick reminder. Liking the video, subscribing to the channel, and commenting helps this reach more people who care about Bitcoin and macro trends. Appreciate the support.
You call the U.S. economy a coiled spring for many reasons. I'm wondering how you think that translates into what the markets may do this year.
Yes, well, we think that we've been through a rolling recession. We've seen it in housing, manufacturing, small business, consumer sentiment, and that thanks to tax cuts, big refunds this first quarter, but corporate tax cuts as well, so big investment cycle ahead, as well as deregulation, which I think is highly underestimated in terms of its impact, and lower interest rates and lower inflation, sounds like Goldilocks, that is all going to play out this year and be very good for the financial markets.
I thought it was interesting in reading your outlook when you talk about multiples, which are at great debate, I think, right now, whether 22 times is too rich for stocks, whether you will get multiple compression, but earnings are going to be strong enough that it's not going to matter, if you want to use that word, to the market. You, in fact, do think that multiples will compress because of productivity gains, but that stocks are still going to return double digits this year, and that some of the best bull markets have happened in times of multiple compression. Is that correct?
That is correct. We saw it in the 90s. Big multiple compression, and the market did extremely well. We saw it in the early 2000s, and even ARK in 2017 and 18. Our multiples compressed significantly, and we outperformed the markets significantly in 2017, a big up market. But even in 2018, that was a down market, and we were up, which many people didn't expect.
It's curious to me, I think, that of your 5 themes for 2026, AI is at the top of the list. But you do not own any large positions in any of the hyperscalers. You have 1% positions in Meta and NVIDIA and Amazon, and we can get into NVIDIA specifically in a moment because there are things I want to ask you about that. But why is that? If AI is such a big theme of yours, why don't you have bigger stakes in any of the so-called hyperscalers?
Right. So one of the reasons is we think the shareholder base of those companies is changing and will continue to change because shareholders in the last cycle who got used to huge cash flow and cash positions building, very little M&A because the FTC had shut down M&A. All of that is changing with AI now, and with a new FTC. So we're seeing huge capital spending and returns on invested capital probably coming down for a while. And the shareholder base in those companies has really stayed with them because returns on invested capital had been moving up. I think this is a bit of a shock to their system. And as you know, we are very focused on, more pure play future winners. I'm not saying the Mag 6 won't win. In many ways, they will. But they certainly, any company that is in the broad-based benchmarks and has risen to the top has gotten there because of past performance and a certain DNA that worked during the last 20 years or so. We think there's so much disruption happening now, technologically enabled disruption, some that will benefit, some that will not benefit the Mag 6. So we're much more focused on, the companies that are not as well known, but are going to benefit enormously from the year ahead and the years ahead. And I will say, last year the market starting to broaden out away from the Mag 6. We outperformed. We're in the top 5%, I think, four of the top 5 ETFs by Morningstar. And even for the last 3 years, we're in the top 5%. So I think the market is beginning to understand what we've been trying to say for a long time now.
Cathie Wood's message is ultimately one of cautious optimism grounded in innovation. She sees an economy emerging from a rolling recession, compressed like a spring, now ready to release growth driven by productivity, deregulation, and technological disruption. Even as valuation multiples compress, earnings powered by AI and innovation can carry markets higher. The future, in her view, will not belong solely to yesterday's giants, but to companies building tomorrow's infrastructure. For investors willing to look beyond the headlines and focus on long-term transformation, this may be the beginning of a powerful new cycle.
Regardless of what you think about artificial intelligence, this is the story of the labor market. Short run, I think that there's a headwind, especially for entry-level workers. Long run, though, I actually agree. I think that AI is going to create more human jobs. I think that people are going to have choice, whether they want to work or they don't. And Elon Musk, he recently talked about the idea of universal high income, an age of abundance. I think that artificial intelligence, synthetic superhuman intelligence, that's what's now available in your computer, that is going to change the world in a very interesting way. And I think that investors need to pay attention because the winners and losers of the past might not necessarily be the winners and losers of the future. Stablecoins have become very popular. What is driving this adoption? Now, I don't think people quite understand just how popular these assets have become. I recently saw this stat from Binance Research. Stablecoins' annual transaction volume hit $33 trillion. That's nearly doubles Visa's volume of $16 trillion. So think for a second here. We have stablecoins that are now 2 times the annual transaction volume of Visa, the most popular payments network in the legacy system. Now, what Binance Research calls out is that the velocity of stablecoins is about 110x. That's the turnover per year versus traditional fiat M2 money supply velocity of 1.4x. So when you think about this, it basically means that stablecoins have become popular because they're available 24/7. They can be used at any time. They can actually be used from anywhere, and there is high liquidity and low friction. That means that you're reducing friction in the system. So of course, people want to use this more. It's cheaper, it's faster, and frankly, it's just a better experience. And it can be done by anyone in the world at any time. Compare that to the legacy system. If you've ever tried to go and send a wire or go and actually do an ACH, sometimes you even have to tell the bank what you're doing with the money to get your own money out of the bank. All of those friction points are obviously things that slow down the velocity of money. They slow down the usage of fiat cash. But now what we've done is we've taken that fiat currency, we've simply digitized it in the form of a stablecoin, we've put it on a blockchain on the internet, and we said anyone with an internet connection, have at it. More liquidity, cheaper, faster, available 24/7 from anywhere in the world. No wonder stablecoins are winning. And my guess is that there's a lot of panic going on at these legacy firms because they realize where the world's headed. Don't view this entire system in a static mode. Yeah, of course, stablecoins are 2 times bigger than Visa on an annual transaction volume, but imagine 10 years from now. You may not even touch any of the legacy fiat rails. That's how fast this stuff can change, and there is disruption on the horizon. I think that's why you see Visa, MasterCard, and others trying to figure out, what's my crypto strategy? How do we use stablecoins? And what are we going to do to cut this thread off before it takes down our business? Do institutions hold too much Bitcoin? I think this is a very important question. Now, there's two ways to look at this. You can look at the total amount of Bitcoin that's held by corporations and institutional holdings. Binance Research went and they put it at 1.1 million Bitcoin. That's about 5.5% of the total supply. Of that 1.1 million Bitcoin, about 700,000 is held by Strategy. Now, when you look at that, they started at zero just a couple of years ago. So there has been a very fast growth from 0% or so to 5.5% of the total supply. That's what you would expect as institutions who have a lot of money start to adopt Bitcoin. On the other hand, they only own 5.5%. If you look at the total supply of money in the world, obviously the institutions and the corporations, they got a hell of a lot more money than, let's say, individuals do. And so to only own 5.5%, that means that about 94% of the total outstanding supply is still held by the people. And so the question is not whether they hold too much today, it's that 5, 10, 15 years from now, institutional ownership of Bitcoin is going to continue to increase. If Bitcoin's good enough for people, it's going to be good enough for corporations and central banks. So you're going to see them. That's what mass adoption is. But where is the line? Is there a number that we should be uncomfortable with? Is that number 10%, 15%, 20%? Nobody really knows. But one of the things that I would do is I would look at the legacy system and see what the distribution is between corporations and institutions compared to individuals. And if Bitcoin ends up being more individually held, then that's an improvement from where we were. Of course, I want people to benefit from Bitcoin. I think that a decentralized digital asset that has the ability to resist not only debasement, but also censorship and censorship, it's a good thing for people. It gives them back their freedom and gives them back their time. That's why I love Bitcoin. But ultimately, I think that we need the institutions. We need the corporations to adopt this. If you want true mass adoption, that means you got to be comfortable with everybody. Good people, bad people, big people, and small people. Everyone is involved in Bitcoin, and that's what we're getting. I think that's why Bitcoin continues to win, and I don't think that there is a level that we are anywhere close to that is too much corporate or institutional holdings. But again, at some point, we may trigger that line, and so you've got to decide for yourself. Where would your line be? For me, we're not anywhere close to it.
Anthony Pompliano's message is ultimately about inevitability. Artificial intelligence is reshaping labor and productivity. Stablecoins are redefining money movement. Bitcoin is emerging as a decentralized asset that both individuals and institutions can trust in a world of accelerating change. These forces reduce friction, expand choice, and shift power away from centralized gatekeepers. And while the transition won't be smooth, the direction is clear. The systems that move faster, cheaper, and more freely will win, and those that don't adapt will be left behind.